Hi Mr. Vendor, I know your property is worth £100,000, but I would like to pay you £75,000. Oh, that works. Now why on earth would a vendor sell their property below the market value? If you've been on the property forums, especially the property Facebook groups out there, you may have seen the acronym BMV. But what does it actually mean? Below market value, or another way of seeing it is as an investor price, is essentially getting a property agreed at a price that is below the RICS valuation. So a RICS is a Royal Institute of Chartered Surveyors, and they will go out and value the property, for example, at £100,000. And if you get the property price agreed under that £100,000, then that would be classed as a below market value property. Typically, what we're expecting in this market is about 15% BMV, so around 85,000. Back in the day, before the prices went like that, you could regularly get properties 20 or even 25% below the open market value. But why would somebody sell their property at this price? Most people make the assumption that people need to sell their property below market value due to financial reasons, and that can be a heavy indication. You know, if somebody's getting repossessed, maybe they're struggling to make their mortgage payments, or there's been some damages, or something comes up in their life that they're needing to fund, that is a heavy motivation to sell the property below market value. But actually, there are other reasons and indications of why they would need to do this. A lot of it is around speed and certainty. So for example, there are repossessions. Sometimes it's an issue with the property. Maybe there's been some structural issues that are needing to sell the property at a discount. Sometimes it can be repatriation, where they're moving out of the country quite suddenly. You see this with people in the army, for example. Sometimes it can be a probate property, where they've inherited the property, maybe become an accidental landlord. The point is, there's actually a plethora of reasons people need to exit on these opportunities. And as an investor, we naturally assume everything is about money. Well, of course we do. As investors, we're obviously making purchasing decisions based on the return on investment that we're putting in. But what you need to realize is somebody selling a property is not always about the money. Sometimes it's about a problem that they're trying to get away from, or a pleasure that you're looking to go ahead to. For example, if I'm about to get repossessed, or I've got a problem tenant in the property, or I've got some financial issues that I need to get out of. Maybe they're a developer that needs to fund another project and they need the money away from that pain. Maybe they're moving abroad. We once had a vendor that was moving to Thailand and starting a business out there, and the only thing that was stopping him achieving that result is the property being left there. So remember, it's all about the situation going on, getting away from the pain and towards the pleasure of the opportunity in front of them. Some top tips around this. There are 3 key reasons why people sell below market value, and you need to be aware of this. Number 1 is a problem with the property, i.e. there's structural issues, maybe there's Japanese knotweed going on, maybe there's some issues with the roofing and there's been a leak and caused some damp issues, but more than likely there is some issue with the property, because let's face it, if the property were in pristine condition, in a majority of circumstances, they would just exit on the open market value and get something for that. Number 2 is there's a situational problem. What I mean about the situational problem is a problem with the situation of the tenant, even maybe they're not paying in the property, a situation of the environment, maybe there's neighbors that are causing major issues, or a situation in the location in terms of a demographic downlift. What this means is it could be schools in the area, Ofsted has written off the local school, maybe there's a big sign off on an infrastructure investment that's gone down the pan. Any situational thing that's going on will impact the property price. And the third and final one is around the person's situation. So this is the personal situation of the vendor selling the property. So this is more reason-based analysis. So it could be the developer that's selling off this unit so they can fund the rest of the development. It could be that individual has just been fired from their job and they're worried about the money in their bank and they're looking to relieve themselves of the asset to have a little bit of buffer going on. It could be that actually they've inherited the property, they're an accidental landlord and they don't want to do that. They prefer to focus on their job and just get rid of the property. It could be that the probate has come in from somebody that's died, they've inherited it and they want to move on. Just be aware that when you're taking on a below market value property, that there's usually an issue with the person, the property, or the situation. Some final tips about taking on BMV property, and the big one that overarches everything is don't just take account of BMV. You have to realize that in most situations, there's a reason that it's below market value. So even though you've got a heavy discount on this, make sure it's not in the Bronx. And when I'm saying the Bronx, I don't literally mean the Bronx. I mean, if it's an area, it doesn't matter if I'm getting a 50 grand property for 20 grand. If I'm going to get shot whilst viewing the property, I don't want to buy it there. If I'm going to get my copper ripped out of my property every time a tenant goes in, I don't want to live there. If there's going to be a drug den in my property, I don't want it, I don't want to be there, okay? And so don't put them in areas where it's not about would I want to live there, it's would I want my dog going there? And if I don't want my dog that doesn't exist going there, then I don't want to buy the property there. Number two, is it cash flowing? If there's a cash flowing opportunity, it kind of dampens the issues that could arise with buying the property. So if it's cash flowing already, amazing, or if it's got a cash flow opportunity, that's going to be really good as well. Next is the history of the property. Do some background research. Has it tried selling a few times over the last years? Use that as an indicator to if you actually want to buy this property. Because if it's 20% below market value, but actually it's been trying to sell for the 100 grand valuation 5 times over the last 2 years, I'd probably want to do more research into what issues are actually coming up that's stopping this, realizing the full value potential of the property moving forward. What I mean by this is, are there any environmental factors that are come into play? So I always look into the infrastructure in the area, what investments are going on, what development plans are there coming into play. There's one, Small Grove, that I filmed on here and put out, and I really like it. It's in Doncaster, which is the area of Doncaster that it's in is a bit rough, but I happen to know there's millions going into the development in the area, so I've got that edge that even buying it right now, I know it's going to go up in value, and even since I've owned it, it's gone up about 10 grand in value, and that's in the space of about 4 or 5 months because of the environment it's in. Also with that property, I can add value through refurbishment. So you hear these things like for every pound you spend, you get £3 back. It's absolute rubbish. It hasn't been that way for many, many, many years in property. But always factor in that if you can do an extension, either 1 story, 2 story, maybe add a garage, look into the ways that you can add value and street appeal to the property to maximize your return and mitigate your risk. Final top tip is be careful about taking on other people's tenants. So first of all, if they are selling the property because the tenant hasn't been paying for 4 or 5 months, don't assume, hey, I'll buy it and just kick the tenant out. It doesn't work like that. So if there's a tenant in and you're purchasing it below market value because either it's tenanted or it's got a bad tenant or they haven't been paying, you need to make sure that you've done your basic checks. So you can find this on the government website, but you need to make sure that they were issued when they moved in, not now, when they moved in. Did they get a copy of the EPC, the Energy Performance Certificate? Do they have the right to let in the UK? Was that checked? Do they have a valid AST, Assured Short Hold Tenancy, which is a rental agreement? And have they been given the right to let guide, which is a government standard issue in the UK? If any of those haven't been given to the tenant, it's very difficult, in some situations near impossible, to evict a tenant even if they are non-paying. So make sure you're doing all of the checks as if you were taking them on as a new tenant, and if for whatever reason they haven't ticked those boxes, I would think very carefully before moving forward with that property. So, have you ever purchased a below market value? Let me know in the comments. How did you find it? What was the situation? What was the problem that you were applying a solution to get in there? And if you enjoyed this video, make sure to leave a comment, hit the like button, and of course, if you're new to the channel and you want to find out more about property investment, make sure to smash the subscribe button and the notification bell so you're notified when the next video comes up. Hopefully you got value today, and I will see you in the next video.